today's market movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Iuorio, and today we're talking 10-year Treasury options and the fascinating cross currents that are pushing yields right now. Now, a few short weeks ago, the Fed was talking about balance sheet reduction, in other words, ending quantitative easing. Since then, the world's changed dramatically with global risk headlines and several domestic natural disasters. Joining me is Chief Investment Officer, Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, Scott, what's currently pushing 10-year prices more?
Well, whatever it is, it's pushing me around a little bit, I'll tell you that much, because it's been quite an interesting trade, in my opinion, because you talked about the Fed involvement, or lack thereof. You talked about some of the natural disasters. To me, it's a couple things. I think it's largely geopolitical in the sense of the fact that we have North Korea piping up again. We have some demise in D.C. with respect to tax reform. That stuff put together seems to be putting a bid in the ZN.
I agree. I think I would put it in global headline risk. There's been saber rattling between the U.S. and North Korea. That seems to put a shot in it. And I also think the Fed's not going to ease until they can figure out what the economic effects are going to be of these two disasters. Do you agree?
Well, that's true. And with respect to maybe the Fed putting another rate hike in the bucket by the end of the year, that's questionable. And maybe the fact, too, that, yes, while the economic data is getting better, it's not quite good enough to spur inflation. We saw that in the jobs number recently,
Indeed,
where there's really no wage growth.
Now, before we dive into our trade discussion, I'd like to point out that, as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Price and movements will vary. The market now, we're talking about the D's 10-year, currently trading a little bit over 127, 127.03. Scott.
So the ZN, as we noted, has been a really interesting trade from the standpoint of the backdrop that we laid out. So I punched up, as usual, a lot of call and put spreads today just to kind of figure out where I felt the relative value was vis-a-vis what we're going to pay for it, right? So specifically, I'm looking, Jim, at the week 3 September 128 half call spread in the ZN. This will cost you only about 4 ticks or $62.50 of an outlay. It expires September 15th, so you have a little bit of time in this one. The underlying, as you mentioned, slightly over 127. It's going to risk the $62.50 you put out to make a potential $437.50. Now, why did I put this on? If you look at the recent range in the ZN, there's that kind of top end around 128 that if we bust through that with maybe a little rattling out of North Korea or something like that, you could see that trade up into that, say, fill out of that call spread I mentioned.
When you're looking at being long the 10-year, does that coincide with being short the stock market in your mind?
See, that's what's interesting, though. If you were an alien and you came down to Earth and looked at these two trades, whether it was the ES and the ZN put together or separately, you're going to say they kind of trade together. The ES is held in there pretty well, considering we've seen the boost in the ZN.
Completely. And you know that I'm still a bull in the stock market, and I think Treasury yields are going lower, prices going high. So I'm looking at buying the week 3 SEPs, same expiration as yours. It's funny that we're both on the same page on this.
For once.
But the 127.5, 128 call spread, a little more likely to happen because it's closer to the strike for 7 ticks for 109.37. This trade expires September 15th, same as yours. It costs 109. That's what you risk to make a potential 390.
Now, see, I like this for 2 reasons. One, because you're on my side finally, because you've hit a lot of these. So I like being on the same side of the table with you, besides the fact that we're on camera together. But here's the other thing. When you look at these trades or these expressions, they have a nice risk reward in them, meaning that it's not like you have to wait for it to completely fill out the whole spread. You can manage it with respect to what you're outlaying. If you're comfortable maybe making the money back, making a little more than that, take it off.
Agreed. Last question. Is the 10-year alone as the risk, the purest risk-off play right now?
I believe it is, but you know what's been back in play now? The GC, which is an interesting thing to look at with respect to how it moves versus again, especially considering how low interest rates are approaching 2% on the 10-year.
Right. Thank you for joining us on Market Movers. I'm Iuorio, where we're trying to help make you a better trader.